Welcome to the Dividend Talk podcast, episode 183. Earnings from six popular dividend stocks. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJI. We're still in the middle of earnings season, so I assume you've been busy.
Well, actually, with work, yes.
Yeah.
So, how my routine is, right? Quickly before I go to work, I've got like an hour in the morning because in this season, I usually wake up an hour earlier, like at 6, do my stuff. And then between 7 and 8, I go hit all the investor relation pages, quickly read it. I spend like 5 to 10 minutes on it. So it's usually headlines, go into it and post it on social media, like specifically the dividend hikes that I'm interested in. But I got a little bit more chance now also in preparation for this podcast to go a little bit deeper into the earnings. And yeah, it's a madhouse. It's just a madhouse. It's amazing. We'll see it later with the dividend hikes. But I mean, isn't this a great time to be alive? These weeks in the year, they're awesome. They're really, really awesome.
Yeah. Do you know who I feel sorry for? It's those with like 60, 70, 80 stock portfolios. I mean, how do you keep track of all that kind of ETF-like portfolio? There's just so much happening. As you said, we're going to see from the dividend hikes alone. And we've covered 6. We could have covered easily. Like, we're trying to cut down who we're not going to talk about, which is crazy, right?
Yes. So for me, I like this season so much because a lot of this is now also confirmation about our investment thesis in these companies, because you can look at it from a quarterly earnings point of view. Of course, if you could consider this also the fourth quarterly, but if you look at the European stocks that we cover as well, you get way more information now, and also the dividend hikes. So yeah, it's a lot of confirmation, and that's why I usually do in May some spring cleaning, because then all the annual reports are released. It gives me really a good feeling of like, okay, am I still having conviction for this stock or not? Because I'm not a buy and hold and never forget and never sell investor. I'm kind of a buy, hold, and review investor. And while I try to limit the changes in my portfolio, because they sometimes like your portfolio is like a bar of soap, right? The more you touch it, the quicker it's gone.
Yeah.
So there's something to that, but there are just some companies that you just make a wrong mistake, or you get caught up in the hype or something like that, and yeah.
Yeah. No, it's definitely the most interesting, I would say, earnings season of the whole year. I mean, an awful lot happens. It's the start of a year, and you're getting a lot of guidance for the year ahead, and you're getting a lot of noise as well. So it's challenging sometimes, but that's why, hey, that's what we love. That's what we do. So
Exactly. But I was very busy at work this week, so I was just wasted even when I got back home. But I still had the time to listen to Jerome Powell, talking in 60 minutes. I was watching him on YouTube, and because we always say, don't care really about macro and about interest rates, and it doesn't mean that sometimes the headlines in the YouTube algorithm don't catch my attention. And in this case, what was so funny about it, I mean, people are so caught up on these rate hikes and not and when it will happen, right? And I sometimes wonder, like, why do analysts spend their time on this? I know that at this moment in time, in this let's say decade, the interest rate pretty much defines what the stock market is doing. Yeah,
Yeah.
this is, from my point of view, we're not having a free market either, because the government, the US, Europe, they're just manipulating the stock market with all their money printing and everything. Yeah, so it does matter. But then if you see all these predictions from analysts, and then you just hear Powell say, like, you know, we think that the economy is looking pretty well. We think that inflation will decline, right? But we want to get some more confidence that this is really like sustainable. Yeah, so they are not in a hurry to lower the interest rates, and I can see all these analysts already, thinking like, "Shite, there go my predictions, there go my, I don't know, bonuses or something like that." And sometimes I wonder, like, why don't they spend a little bit more time on just analyzing good businesses, not look at the stock price? Because every time when the stock price goes up by 10 or 20%, suddenly they are adjusting everything so that I said their ratings stay near the price, right? So that they look good. But I mean, I don't think it's even nice to have a job as an analyst because it's so shallow. It's so shallow.
There must be serious pressure on these analysts. Why else would they jump up and down and change their predictions every time the share price moves? So there's probably serious pressure there. But I mean, Powell really has so much power in his hands. And like, he didn't say he was increasing rates. He just said he was going to hold off on decreasing rates. And all of a sudden, you've got real estate investment trusts dropping by a couple of
Yeah.
percent. I mean,
Yeah.
if I had his power, I'd be a billionaire. I'd be shorting the market before I come out and make an announcement, and then I'd be buying the market when I make a good announcement. It's
Like Nancy Pelosi.
yeah, pretty much. Yeah, I mean,
Yeah.
look, I'm sure somebody's in the know somewhere, but as a dividend growth investor, particularly with real estate investment trusts, and there's three that I'm bullish on, which is
Yeah.
Agree Realty, Realty Income, and Vici. Every
Yeah.
time this guy comes out and says something like that, it just creates more buying opportunities.
Yeah.
So I'm thankful. I'm thankful for him. I really want him to say, I'm thinking about drop or increasing the rates and not increasing, right? Just to say he's thinking about it, because boom, we'll see a 10%
Oh,
drop.
maybe we should send him a hoodie or something like that with "Bankers are wankers" as a thank you from the podcast. Yeah.
Yeah, yeah, I'm sure he'll hang it up on his wall or
I,
something.
I I assume he will wear it in one of his upcoming speeches then. Or maybe because he wears a suit, maybe just a really small clip with "Bankers are wankers," so that it's very subtle and you need to zoom in to see it.
On the tie, yeah, on the
On
tie.
the tie, yeah. Yeah, on the bottom of the tie.
Yeah,
Yeah.
yeah. Lapel. That's not a bad idea. But look, I think it's quite interesting that the market reacts the way it does to a 60-minute interview that this guy has every single time. It seems like it overreacts. So I'm sure people profit on that. But I think as a dividend growth investor, he's just given us opportunity after opportunity to pick up
Yeah.
some decent companies at good prices.
That's why I focus on good businesses, because in the short term, maybe an interest rate matters, in the long term, not. Yeah. So if you have a good business that manages the balance sheet well, they can deal in higher interest rate environments, lower interest rate environments, and then you don't need to care about this. Yeah, this is really for traders, for analysts, for but not for retail investors like us. So
Yeah.
it's a lot of noise in the system. People are unfortunately very sensitive to this stuff, to macro and such. But for my portfolio, it doesn't really matter. But hey, talking of which, there were some really noteworthy dividend hikes. We will not do everything, but let's start with some European ones. For me, a personal favorite that I'm really, really getting close to pull the trigger one time is Assa Abloy. Again, they hiked the dividend by 12.5% from 4.8 to 5.4 Swedish crowns. My favorite locksmith, I must say. And I see them a lot, you know. The other day again, they were renovating a part of a shopping mall, and what do I see again? Doors that are still in the covers with plastic with Assa Abloy on it. It's just everywhere here, and it's so amazing. Yeah, you would think sometimes they use like, I don't know, B quality or something like that as well here in Poland, but no, I see it everywhere in those shopping malls where they're
Yeah,
renovating. So
yeah. And
amazing.
and what about then Hermes International? I mean, they hiked their dividend by 15.4%, up to a whopping €15 per share if you owe them. And that's on top of a special dividend that they pay around €10. So effectively 25 euro per share on dividends.
Yeah, it's crazy. I also believe that every employee gets 4,000 euro in bonus this year. I mean, cash is just slashing against the walls in the office there. Yeah, and
Yeah,
it's
I s-
such a smart business, right? And maybe we need to write a little bit deeper about it, but they're really using scarcity to drive up prices and demand for their products.
yeah. I mean, I was just going to say, I seen maybe it was on our Facebook group that their top selling or the biggest revenue drivers from bags, leather bags. But if you
Yeah.
walk into their store, there's not a bag to be seen. It's, it's
Yeah.
crazy, right? So I mean,
Yeah.
the people that they are targeting are not walking into a shop to buy a bag because they don't want to see the bag they're walking down the street or going out to a party with on display
Yeah.
in the shop. So it's I found that mind blowing. It's
Yeah.
a great business model. They have. I mean, I feel like they're the opposite of Louis Vuitton, who are quite
Mhm.
clear in that they're not a luxury brand,
Yeah. Yeah.
even
Yeah.
though
Yeah.
even though they technically are, but they go out of their way to say, look, we're not. Whereas Hermes are fully embracing it. They're like, hey, we're full blown luxury. You want luxury, you buy our bag off us. So
Yeah.
it's an interesting one, but
And yeah, if you look at the next French stock, L'Oreal, again a 10% dividend hike. And yeah, we will speak later a little bit about the earnings then, but another one in the pocket again. And I own L'Oreal now since I made this first dividend growth compass newsletter about it. I bought a share, so happy with it. Is of course for me,
yeah,
pennies, but still, it's always nice.
yeah. And then what about a bank? We've got Nordea Bank, which increased it by 15%.
Yeah, I had to add this one because Alan, the friend of the podcast, he was so joyful. He was so happy when he saw this, and
Yeah.
he's always talking so nice about Nordea Bank because Nordea Bank, I believe, is the bank where all his dividend stocks are automatically getting the dividend taxes reclaimed. They seem to have something like that in Sweden, even
Mm.
by law, he says sometimes, and seemingly they just withheld all the dividends already according to the treaty, which is amazing. I wish I had it. Maybe I should sign up just as a citizen to Sweden just for this one.
Yeah. Yeah. And then we got Total Energies, 6.8% hike, which is not too bad. And followed by Equinor, who raised their dividend by 16.6%. I mean, there's a lot of big dividend hikes, isn't there, this year?
Yeah, because I think like but this is oil and gas companies. Yeah, I think they just have a lot of cash flow still coming in, so they can do this buybacks, and buybacks often contribute to the fact that then the gross dividend hike overall doesn't need to be so much because it's already paid with by the buyback. Yeah, so
Yeah. And then we've got British American Tobacco, who I'll speak about later, hiked their dividend by a mere 2%. Valmet raised their dividend by 3.8%. And according to one of our Facebook members, they are now a European dividend aristocrat.
yeah, this was so funny, first of all, because Lars Eric, I believe 2 or 3 days ago, I think he had like 6, 7 posts on Facebook because we have this habit on Facebook to say kaboom, dividend
Yes.
hike, right?
Yeah.
And on a single day, I think he must have had half his portfolio hiking the dividends with quite solid dividend hikes. So it was so funny to see him. This is also what I love about the community, right? We're like kids in a candy store when we see these dividend hikes.
Yeah.
So
Yeah.
it was
Uh,
just funny to see
I,
this.
I find it funny when someone posted no kaboom today or something, something along those lines.
Yeah.
It's like,
I had the other day kapoof because it was so disappointing.
but let's not forget about some of our US friends. We've got PepsiCo, who we'll speak about again on the show, hiked their dividend by 7%. That's up to $5.42 annually. Hershey, HSY, they've hiked their dividend by 15%. I mean, these guys have been on, I don't know if they've been on sale, but they certainly have dropped over the last couple of weeks.
Mm,
And if you bought into it, you're going to be rewarded with a nice 15% raise there, which is, I think it's incredible for that type of company. And then we have Simon Property Group, which hiked their dividend by 2.6%.
yeah, and SPG is continues to impress me. It's one of those few A-rated real estate investment trusts together with Realty Income,
Yeah,
and they're effectively, I believe, also having a stake in one of the French shopping mall real estate investment trust. Is it
yeah.
Clapier? Clapier, I believe.
I think so. I don't know off
Yeah,
the top
one
of
of
my head, but
those.
yeah,
So it is also a large European presence, but they continue to impress me. Yeah.
yeah. And what about this one then? What about 3M and their dividend of 0.7%? Not 1%, 0.7%.
Yeah, because they hiked it with a cent
Yeah,
per quarter.
yeah.
I mean, we know all about 3M, right? The litigations, they're just screwed. They have no wiggle room. They want to keep their status as a as a dividend aristocrat, dividend king, but they're screwed.
Do you know what? The more and more that I'm in this game, I actually prefer the European model where they increase it based on earnings and not on this status, because that's really a bullshit race, and
Yeah,
it's purely designed to keep their dividend king status, which I don't believe they can maintain. So
yeah,
I don't understand it. I would much prefer them to come out and say, look, we're in a whole world of trouble here. We're not
yeah.
raising the dividend for that reason. And
We'll protect the business now. Yeah,
exactly, it makes sense. I know it's only a penny, but I mean, to me, it's a slap in the face as a dividend growth investor. To be
yeah,
fair,
yeah.
um,
Well, at least gives us enough time to sell it, right?
yeah, yeah, of course. What about Walt Disney? We both sold them.
Yeah,
They are now a dividend company again, and they are hiking. Well, it says hikes by 50%, but their dividend will now be 45 cent biannually, and they've
yeah.
also announced a 3 billion buyback. Um,
Yeah, and they also announced an investment in Epic Games with Fortnite at the
oh,
same time. So they also, I believe, are going to finally launch an ESPN streaming, I believe, next
yeah,
year.
yeah.
I mean, they're making steps, but you know, show me the money. Yeah, that's what it's all about for me. And I use Disney Plus already for a long time, and because it's a bit more kid friendly. But I just turned on Netflix the other day because with the missus we wanted to watch a certain series again. If you see the content difference between Disney, it's just not comparable.
Yeah.
Disney is boring compared to that. So there's still so much work to do,
Yeah.
Disney, and I'm not buying into it for the dividends. It's not the company anymore that it used to be from that point of view. They're struggling.
I mean, they seem a little not. It's a bit harsh to say, but they seem a little bit lost in that regards. I mean, they cut the dividend because they wanted to be a growth stock, and now they're what? They're no longer a growth stock. So
Well, the issue is in this business, content is king.
mm, yes,
What is a popular Disney movie that you, as an adult, let's say, an important target group because you have money in your pocket that you remember from the last year? And now tell me a Netflix series or movie that you have seen.
yeah, that's true. That is true. Netflix is definitely doing better. I actually can't think of any Disney ones, and that's really sad, actually.
Content is king.
Mm.
Content is king. Yeah.
Yeah. Now, I'm not a huge movie buff, so I might be the wrong person to ask, but you would think you would
No,
remember something.
but this business model of Disney, they need content for their Disney parks to have new attractions to keep people going. They need it for so much for the merchandising and everything. So, and if they're not really, they're just milking out existing things.
Yeah,
Like, do we need another Avenger movie? Yeah. Or Star Wars, but new? No, but if you go to Netflix, there's continuously something new
yeah,
and popular, right? So and then I could see Netflix also maybe one day having a park or something like that. For instance, for Stranger Things, they could, I can imagine that one time they make a park with, Ghost House or whatever it is, the upside down from Stranger Things. They could do all this. What Netflix is still ahead of it.
yeah,
Content is king in this business, and Disney is not on top of it, and that's what's scary here.
yeah. And then a couple other dividends. Actually, they're not dividend hikes; they are dividend flatness. I would say. Unilever kept their dividend flat again, and again, I'll speak about them later on. And Union Pacific keeps their dividend now for 8 quarters without a dividend hike.
Yeah, so they're not doing a good job rewarding us.
No, no, not
What
at
did you do
all.
with Unilever? You had some considerations there. Did you make any decision?
Yeah, I did. I'll tell you when we get there. But I
Okay,
I
good,
I did make my decision on
good.
them. But do you know what? Let's start with Unilever, will we?
Yeah,
Seeing as you asked the question, we might as well start with Unilever. And look, it wasn't a fantastic performance from them. They did break their duck in terms of volumes, so their volumes were declining for I think six or 7 quarters in a row. The volumes are up, albeit by 0.2%. So it's not something that breaks the bank by any means, but at least they've seemed to bottom out in terms of volume. What I do like and what I am impressed about this company is the CEO Heinz Schumacher. I watched his fireside chat. I feel like he's straight talking, no BS kind of guy, and he pulled no punches. I have to say in this report in this call as well. They are, in terms of gaining market share, they are not really gaining as much as they want. I think it was at 37% over the last 12 months, which quite frankly is not good enough for a company like Unilever. But he says it straight out. He said, look, volume increased for the first time in 10 quarters, actually, not six, in 10 quarters, but, and in quotes, our competitiveness remains disappointing and our performance needs to improve. And to be honest, it's quite refreshing for him to say that. He didn't pull no punches. Um, Unilever like to hide behind this USG, UVS, this, their sales growth, their underlying sales growth, volume growth. But actually, he's saying, look, we're not winning market share. Our power brands are not doing what they should be doing. It's quite disappointing, and we need to do that. They've talked about this growth action plan, but again, it doesn't give me a warm, fuzzy feeling. Do you get me? It's just words on a page for me. But what he's saying is they're putting basically new leadership teams in place to maybe start the foundations of growing these out. They're going to focus on these 30 power brands, and that's great. How they're going to focus on it, I don't know. But what's interesting is marketing is going to go up quite a bit, and it's already increased 14% over the last quarter as well. So I think they're really going to push hard. But look, in terms of performance, it's been, as I said, it looks like they've bottomed out where they were over the last 4 or 5 quarters. Turnover has been flat. Everything else has been flat. Their debt has been flat. They're not paying that down, and also their dividend, they haven't grown it again, which is also disappointing. But you, with the ever so eagle eye, had spotted that they changed their dividend policy, to which is now a competitive dividend, I believe. So it's no longer
Another competitive, but they removed the word growing dividend.
growing dividend, yes. So
So they're not committed anymore to growing dividend, which really I find it disappointing and a bit sneaky because there was not an announcement in the policy.
yeah,
Yeah.
yeah, and I remember you spotting that and you emailing investor relations on that. So, and I mean, I guess you can see that because again, they haven't raised the dividend, so you can see it's not a priority for them. And look, he's a new CEO coming in. He's under pressure. The business is under pressure. He needs to perform. Comparing them to their US peers, they are deeply undervalued, but that's because they're not performing. So he's got a huge challenge around him. I get the same vibes from him as I do from Pat Gelsinger. Um, but I mean he does have a big job ahead of him. in terms of volume, as I said, it was up 2%, but he's struggling. Ice cream is struggling. Nutrition is also struggling. Luckily, they have personal care and beauty and well-being, which are two of the biggest markets anyway, which help prop up that sales. But
Yeah.
I think he's got a big job to do. And look, you've asked me what I did with my shares, and I sold them. Um, look, I don't see them as a dividend growth company anymore. They're not. They've kept it
Hmm.
flat. They do seem undervalued. You need a lot of patience with this, but all I'm seeing at the moment is words. I'm not seeing what the action plan is. I don't really grasp the full concept of that yet. And for me, it's just dead money. The share price didn't move in 3 years. The dividend didn't grow in 3 years, and you've got other companies out there that are doing much better. So I want my money to work harder for me and not have to wait as long. So I still think it's a good company. I do like the CEO. I think it's got huge potential, but I don't think it's going to move too fast in the next 12 months. And maybe at the end of this year, we might start to see what the CEO is actually delivering. And I would not be opposed to re-entering a position into them. But at the moment, I'm out.
Yeah, I mean, it gives, what is it, a 3.8% yield at no growth. You can get your realty income at a 5% yield with 2-3% growth,
Yeah,
which is having it's both very much let's say a very safe play, right?
yeah,
But you get growth. You can take even an N group at a 7 or 8% yield with double-digit growth at the moment. So
yeah. I mean,
yeah, I'm with you. I'm with you. It's one of my largest positions in the portfolio, like the top 10. And I'm not considering selling totally, but I'm considering to move it from a tier 1 to a tier 3 or tier 4 stock and just trim half of it and redeploy the money elsewhere. Um, because my thesis is not playing out with the company. And I agree with you. The CEO seems to be on the game. Maybe if I would then how you said in your case, maybe you would need to step back in 50 at 55 or 60 and lose out on some, but at least then you know that the company is growing again and dividend is growing.
yeah, yeah. That's exactly it. Look, it's a shame. I think it's a fantastic company. It has so much potential.
It has fantastic history. It's not a fantastic company anymore, right?
Yeah,
It has great brands, but it's not a fantastic company anymore. And the CEO is effectively doing a turnaround. The only good thing is like such a company like that doesn't decline year over year of 10-15%. Yeah,
yeah, yeah. On the basis that it's a consumer staple and the brands
exactly.
are so popular. So
But
yeah,
that's also means the way around. You
yeah,
don't grow it just like that 10-15% either.
yeah. So it'll be interesting to sit back and watch this. Honestly, if it jumped up 25% in the morning, I made my decision. I'm happy with it. But
Yeah,
sitting back, I really want this company to do well. So
yeah.
I hope he
It's the
does.
European
So,
pride. Yeah.
exactly. Yeah.
So hey, then look at another. Let's look at another company then. Because I've been looking into L'Oreal a little bit. As I mentioned earlier, I own a single share in it, very proudly. The company really dropped. Yeah, it dropped by it was 7 or 8% when the earnings were released, and that's very interesting. Because if I tell you that the sales grew 11% like for like and 7.6% if you take the currency and everything out, you wouldn't expect a company to drop so much, right? You wouldn't.
Not
So
not in a million years. No.
no, no, no. And if I tell you that the earnings per share are now 12 euros, up by 7.3%, they hiked the dividend by 10%. They've got cash flow of 6 billion euros, up by 24%, and the company declined by 8-9%. That's crazy.
Yeah.
Look, hey, it's all about China. China is a weaker consumer at the moment. That's it. But we look so much about China, so I'll give you the facts here. Yeah, in 2022, Europe made 11.4 billion in sales. How much sales do you think North Asia, where China is included, made?
Don't know.
11.3 billion. So this business line of North Asia declined to 10.6 billion, and it was 9.8 billion in 2021. So it's still much more than in 2021. You know what Europe did? It went from 11.4 billion to 13 billion. Now, tell me where this makes sense. Tell me where this makes sense. Europe is showing very high growth numbers, much more than we could have even expected from China. But
Yeah.
because China is down, we smashed the company. We slapped the company. For me, sometimes this doesn't make sense. Of course, probably some analysts would have said, "Well, we accounted on both Europe and North Asia." But I've been studying L'Oreal, and everything is about China, China, China. People are looking there like thousands miles away at China. Well, they forget that in their own cities, people are massively buying L'Oreal and the lipstick and everything, which is so insane when you think about it.
But I also find it bizarre because the weakening consumer in China is not a new thing. You didn't have to wait for this earnings call to know that China is weakening in terms of the consumer. I mean, it's been all
Exactly.
over the news for the last six weeks. You wrote an article on Louis Vuitton. I wrote about one of my key risks there is they rely a little bit more heavily in China than say L'Oreal do. So based on that weakening consumer, that to me is a bigger risk for Louis Vuitton, right? But it's not a new thing. But yet they come out and say, okay, China's a bit weaker than Europe, and it drops by 7-8%.
But
It
for
makes
me, Europe is the big surprise here. So I would
yeah,
have
of course,
expected like an 8-10% up.
yeah, yeah. But
So, this is very interesting, very, very interesting for me. So, hey, a 12 euro EPS at the moment.
mm,
So it's still a pretty high multiple, right? So there's a lot of growth still priced into this company. So maybe it has to do a little bit with that. But then to your point, then people shouldn't be surprised with the China numbers that are coming out everywhere. Yeah. Um, you know, nice thing, right? If you look at the free cash flow, it is around 6.2 billion.
yeah,
Only 3.5 billion goes to dividends, 500 million to share repurchases. So this is really, really solid business, very cash flow rich, healthy balance sheet. So yeah, Mats the pilots asked us like what caused the drop in L'Oreal today. I think it's the China. He thought it was a good report, wants to buy some more, or he did buy some more. And I understand that you get it now for was it 400 euro and change.
yeah,
So it is well, attractively priced. I wouldn't say. I think this is kind of the Charlie Munger one, high quality company at a fair price. Yeah, instead of a fair company at a undervalued price. That's how I look at L'Oreal. Yeah, share price can go up. They can also go down from here. But very interesting how the market responded to a very solid report, where, in my opinion, China was already kind of expected, but not the European one.
yeah, yeah. It'll be interesting if the China drum keeps beating. Will it put the share price under pressure? And if it does, based on what we've seen in Europe, it
Yeah.
presents and it will present a really good opportunity with L'Oreal. Probably a
Yeah.
lifetime, a
And
lifetime
and what the
opportunity.
issue is, I think there are some companies that over the last 10 years have mainly been outperforming or performing so strongly because of growth in China. Think about Starbucks as an
Yeah,
example. Yeah, but also Louis Vuitton. If China is really going to change with the consumer over the next few years, all these companies with high multiples will be severely under pressure because it means that one of their main catalysts dropped away. So yeah, let's see how it goes further in the upcoming year, let's say around China.
yeah,
But yeah, that's a risk reward. That's exposure you have in your portfolios.
yeah, exactly. But overall, strong performance
In my
from.
opinion, strong performance given all we knew already up front.
Yeah, I was giggling actually when we're going through the dividend hikes. So I think you've wrote about three of the companies in the newsletter, and all three of them had double-digit dividend hikes. All three of them. I mean, what are the
Yeah,
chances?
that's just yeah, no, that's just coincidence. And all three I chose because I know they are very high quality companies. Yeah.
Yeah. And the one I wrote about was British American Tobacco, and that had a a poorly 2% dividend hike. But look, we were asked, El Cuba asked us what our thoughts about British American tobacco. And honestly, I think this earnings is like a tale of two halves. It's like a football game. You've got the first half, which is their old combustible unit, which I think there's no surprise at the moment that volumes are declining at a rapid rate. We're seeing that with all all cigarette companies at the moment. So they're still declining and still expected to decline. So that's putting huge pressure, obviously, on their share price, which has dropped. You're getting them for nearly a 9.5% yield because of that. All three are the same. Philip Morris are the same. So they're all under pressure. Volumes are dropping. We know to combat that, they are trying to focus a little bit more on their new category products. And actually, what was really surprising is, and I think it's the first company to do so, is that they were slightly profitable on their new products, which is, I think which is a big deal.
And the trend is really impressive, right? Because in 2020, they were still making $1 billion loss on this stuff, and now they make
Yeah,
make a small profit.
yeah,
So if this continues growing like that,
it's impressive. Now, look, it's still a small part of their business. Their overall growth was down 8%, but it's still impressive. And I have to say, I only got to listen to half of the earnings call. I was listening to my car, and the internet was dropping in and out. But the CEO was quick to say, okay, look, we've seen some really strong growth over the last 3 years. We expect it to grow, but please do not expect it to be as linear as it has been over. So I think he's basically saying, okay, look, it's been good over the last few years, but prepare for the next 2 or 3 years to be a little bit more choppy. So I think that's important to say. But look, I think it's impressive that they were able to do that. What's also quite impressive is that their free cash flow was 8.4 billion. They are
wow.
estimating that to be 40 billion combined over the next 5 years. So that
So
average out was about
8 billion. Yeah,
8 billion a year. You look at their dividends, it's only 5.1 billion. So they can cover that. They can cover that. They can probably increase it by 1 or 2%, which I don't care. That would give me 9% if you buy them at the moment. But what I also like is that they are starting to pay down their debt as well, which I think is smart. I think it's really smart, particularly as we're seeing volume declining. There's going to be a tipping point where that's going to reach a phase where there's no going back, and they can't raise prices too much more, and they can't offset the volume by that. So I think it's smart they're starting to pay down their debt now. So lowering debt, well covered dividends, new product categories growing and positive this year. So I think it's been a good quarter for them. And look, they have reiterated their commitment to growing the dividend in sterling, not in euros or dollars, so in sterling terms, which I think is good. And they've also committed to reducing their debt as well. And look, listening to the earnings call, I think the CEO is doing a good job. They're in transition, new categories. There's going to be lots of regulations coming in. We don't know what those regulations are going to be. Lots of news, so there's lots of uncertainty there. So I think you're getting rewarded with that, with the high yield. But certainly, if they can plateau on this volumes decline, I mean, they look like a good opportunity to buy
yeah.
these.
And weren't they also supposed to turn the buyback machine on a bit again?
Yeah. They mentioned they were buying backs. Listen to me, said sustainable buybacks at sustainable prices. So yeah,
But let's say if they take let's say 1.5 billion buyback annually or 1 billion, that will probably mean what the dividend growth will be. Because if you get it now at 9.5% yield,
yeah,
and if they grow by 2% per year, that's enough for that, because then you have a double-digit return, and they can make this 2% by just buying like 1.5 billion back, use the other 1.5 billion to pay down debt at this moment, and you're good.
and they're super cheap at the moment, so
Exactly.
it makes sense for them to
Exactly.
do that. So it's yeah, a really interesting case, I think, British
Yeah.
American Tobacco.
Well,
It's
what I appreciate about British American Tobacco, right? Because if you look at the share price just over the last year, it's 20% down. Yeah, 20% down. Even over the last 5 years, it's minus 15%. So, but if you buy now and you have this almost 10% dividend yield already, management is managing this very well. Yeah, because they've been because this is where I want to give credit. They're in a declining business. They have this kind of building a better tomorrow strategy that we always make fun of, but they are innovating continuously.
Yeah.
They were able to come with these new products. They were able to get Philip Morris, I believe, to stop, or was it Altria to stop this selling this stuff because of patent infringement.
Yeah.
It's all a result of their innovation capabilities, and the fact that they are really doing well here for me is very impressive. Their payout ratios are around 50-60% of the dividend, so you really have a safe dividend at a 10% yield, which is just an outcome of a conservative management style, I would say.
Yeah. Yeah. As a safe dividend while they're strengthening their balance sheet. It's not strong by any
Exactly,
means, but
exactly.
they are strengthening it. So it puts you. I think it puts you in a good position over the next 5 to 6, maybe not long term because we don't know.
Yeah,
But
yeah.
4 to 5 years, I think this is could be a really solid investment.
Yeah, and then how is it? You don't have like Altria or something like that, where the yield is where the payout ratio is already 85%.
Yes.
Yeah,
Yes.
they really have wiggle room to protect the dividend, even if, for instance, cash flow would decline for whatever reason.
Yeah. And I can't see it happening if they can maintain that 8 billion a year. I mean, over the next 5 years, we're in a strong place.
Yeah. Oh, nice one, nice one. Good to see. I don't own them, unfortunately. Well, someone said like, well, I own them on Trading 212. That's technically probably true because of my Noble 30 pie there. But yeah, don't tell the missus.
Your secret's safe with me and the thousands of listeners.
Yeah, but I don't. I look at it as an index fund, not as an individual holding. I think it's funny. I think I own some banks via my pension plan that I have because it's invested in index funds,
Yeah.
and it's just let's say an S&P 500. So there must be banks in there, right? If I could only choose. Having said that,
Yes.
I wanted to go to Hershey and Yedidia, a funny name. He wanted to really hear the opinion after the dividend hike that we just spoke about, this crazy dividend hike. Hey, look, sales have been just flat. Yeah, they made 2.6 billion in the fourth quarter, 0.2% increase. That's the headline. Organically, it decreased by 0.1 if you take the currency translation out. They also decreased their EPS to $1.7 per share, and overall 11.5%. Full year looks a little bit better. They increased by 7.2% organically also, but that is because late last year they could pass on the inflation to the consumer. Yeah, I think they're struggling now with, again, price hikes and not impacting the volume.
Yeah.
But there's also another thing there. The cacao pricing, yeah, and sugar costs are quite high. So if you look at their full year outlook going forward, they effectively to expect sales to be like 2 to 3%, but their EPS to be flat compared to what it is this year. And that's why I'm so surprised that it's hiking its dividend by 15%. Why would you do that if your earnings are flat, your sales are flat next year? Are they thinking, let's reward the shareholders with a 15% hike because I said because they will not get any capital appreciation, or it is because of the Hershey charity that has the school and everything? Maybe their costs went up by 10-12% due to inflation year over year, and they require this dividend hike to cover the salaries and everything, right? Because that's a special thing here about Hershey.
Yeah.
That and this is what I really like, right? What the founders have done, they created this institution, gave it a large share in the Hershey company, but where it depends on the dividend to fund itself. Very clever. Yeah, it made a dependency there. So Mondelez wanted to buy Hershey a few years ago, but they couldn't because they didn't want to be sold because it would put this foundation at risk.
Yeah.
So for me, it's a very nice example of how you can protect your wealth that you've been building in a very clever way. So I don't know what's driving really this 15%, but it really surprised me to answer the question.
Yeah.
It was not needed. They could have hiked by 5-6%, saying like, "Hey, we keep kind of normal average because our EPS will be flat next year." Still, I would say with the dividend of 5.48 dollar per share, the forward payout ratio is still around 57%, very healthy. So they had the wiggle room to do it, but I think management didn't need to do it.
Yeah.
So that's kind of the highlights. And yeah, the input cost, the commodity cost are yeah, what is causing an issue for them. But also I think competition, right? My son, for instance, he sees this Mr. Beast chocolate, yeah, in the shop. That's what's drawing his attention. And while I'm not in America or never in America really, I did hear that they are getting a lot of shelf space. So I think competition is really fierce at the moment for Hershey because of new products, competing for the shelf space. And if you need to compete with Mr. Beast, that's a tough one. That's a tough one. So and then still hitting these numbers is quite good, but the market is very fierce at the moment for them.
Yeah, tough market. And you have to remember, these guys have been on an absolute tear since COVID. I mean, they
Yeah.
were, if I remember, they were close to $100 near them, maybe 120, and they shot up to nearly 400. So does it present a good opportunity? I think they'll still be under pressure in 2024.
Yeah.
We might see better prices, but 15% hike is definitely surprising. It could be just to show strength as well, to say, look,
Yeah.
hey, we're still here. So
my rule was always with Hershey, you buy it around the 2.75% yield, where it is now.
that's where it is now. Yes.
Yeah, that's always been my rule, because it's such a high quality company. It hardly ever comes into that range. But still, what is 10 $10, let's say, to those, you still pay 22 PE ratio for this, which is still very
Really high.
very high, I would say. Yeah, but nibbling a bit in, not too bad, I would argue.
Okay. I'll move on to my last one, which was Snap-on, and we're really drawn to this because we got questions from Niniok, Anders, and we also got one from Lars as well. So we kind of figured something big had happened. They had dropped quite significantly, about 10%. And I was looking, I mean, the slides, there's only about 3 or 4 slides. I was looking through it, and I couldn't see it for ages. So like their overall sales quarter over quarter grew by 3.5%. Organic sales made up 2.2% of that. There were some acquisitions which accounted for 0.5%, and they had some actual positive currency, which gave them a 0.8% boost. Their gross margin went down slightly. It was 48.5. It went down to 48.3. Their earnings per share was up 7.5%. So I was looking through the report, and honestly, I was there. Why is it struggling? Why did the share price drop so much? And then you look at the individual segments that they have. So commercial and industrial, they actually had a sales gain of 11.6%. So that equates to about 3.3, and they say that's primarily due to a double-digit gain in the sale to customers in the critical industries. But that's partially offset by the sales of power tools. Then they had this Snap-on tool, and this is the part that struggled. They had an organic sales decline of 31 million, which is 5.7%. And this is really because of poor sales in the US, which is their biggest market. So that's actually driven their whole share price decline, because that's where everything else has come from. Their other segment, repair systems, which is quite smaller, had actually a 2% increase. So on the balance of it, it looks like a weak consumer in terms of power tools and tools in the United States is what's causing this to drop in price. It doesn't give too much away, I have to say, on the press release, and also I think 4 or 5 slides. So I would wait for the annual report to get a bit more flavor, a bit more understanding of the impact of this. But honestly, it didn't look as bad to warrant that drop, in my opinion, if I
Yeah.
was looking at it. But I need to understand a bit more around that consumer, why it's dropping, and what their expectations is. I didn't get any guidance here. So what are they expecting in
Yeah.
2024? Will it weaken even more, or will it stabilize? Which is
Yeah.
interesting.
So this is where the earnings call might be interesting to dive into.
Yes, yes. I think maybe listening to the transcript might give
Mhm.
a bit more information on that.
Yeah. Okay, cool. Well, it's a very nice stock, and I still regret that I didn't buy it at $200 when it was trading there like 2 years ago or so. So hopefully we get a chance again anytime soon. Hey, PepsiCo, I want to talk about, and Giuseppe Santa, he asked also about this, and because he would love to hear our analysis. But really quickly, a sidestep, he also asked about my dividend portfolio tracking template, that it's not tracking his UK holdings correctly. That's true. That's because of Google, pence versus pound. I believe on my blog, I even put in the comments what you can do there, Giuseppe. So if you go to the blog article about that one, look in the comments. I think I give an instruction on what cells to change to make this work. Needs a bit of a workaround for UK stocks. Having said that, going to Pepsi, look, the numbers were not so good. I would say, at least for the fourth quarter, like slight decline in revenue. Um, yeah, it's just nothing really. Yeah, there was some organic revenue growth then organically of 4.5%, but also the EPS, well, it was just not so good. If you look at the annual report, annual results, it looks a bit better. 6% full year organic growth, full year revenue growth. But the issue that the company really had this season or this year was the PepsiCo beverages North America, and this is really interesting. So we're talking here about Pepsi Coke effectively in North America. While sales was up by $1 billion, so let's say 3-4%, it just got hammered in the profit, and that was because I read somewhere they had 37% higher input costs or something like that.
Wow.
So they were just not able to really pass that on to the consumer. On the other hand, Europe, the Europe segment was making a loss last year of 1.3 billion, and now they over the full year made 800 million profits. So other business units were able to do the heavy lifting for the impact of the North America Pepsi business, let's say. So that's the benefit of a diversified company. But if PepsiCo would only be the cola, I would hand over fist go for Coca-Cola, because the margins are already much higher with Coca-Cola. Better managed in that area, but it's the chips and everything that is doing so well for PepsiCo, because at less sales, they're typically making more profit on the Frito-Lay business. So it just says that the chips for them is a higher margin business than the Pepsi itself, which is what we know about PepsiCo, right? But yeah, it will be. Did Coca-Cola already announce the earnings? Because if Pepsi is struggling really in North America, I'm very curious what Coca-Cola has done or will do here as well.
Yeah, yeah. I don't know, but you're right. I'm keen to see that myself, how they perform. I'm surprised actually with their dividend hike. It was so high, particularly with their high payout ratio. I think it's close to
Yeah,
85%. So
yeah.
there's not much more wiggle room. I think they did a big hike last year, if I remember, 10% or so as
It is
well.
all the time around 85%. Yeah, this dividend, and I wish that they make it lower by just giving smaller hikes at the moment. I mean, if the company can't really afford it, right, then don't do it. But what they're doing, they're estimating around 8 billion in free cash flow, and of this 7 will go to to dividends, and the other billion will go to share repurchases. They don't need to repurchase. Yeah, it's not like the shares are cheap. Just
Yeah.
pay down debt. Yeah, just pay down debt. Grow the dividend a bit slower. I'm okay with this if it's a bit of a slower growing dividend for the coming years, but give yourself this discussion, this wiggle room. I don't understand it. It expects to grow, for instance, 8% in EPS next year, 4% in organic revenue. Take the 8%, deliver on it, and give me a 4% hike, and do that a few times in a row. Get the dividend back to 70 or 60%. Leverage a bit down instead of buybacks, because at these PEs it doesn't make sense. We will be in a much better place. And I hope with this I also answered the question of Phil B here. Yeah, they seem to navigate the high payout ratio, but I don't need it. I don't like it. It's a high quality business. Don't fool me with high dividend hikes when you can hardly afford it.
Yeah. Yeah. And by the way, Coca-Cola is out on the 13th, so a couple of days time. So
Okay, cool.
that'd be one to look at. So we move on to some listeners' questions. We've got quite a few to get through, so we will start with Stegen. He's asked us, have you Stein? Okay. Have you ever thought about relocating to a country with lower taxes or a low cost of living?
Well, from Poland, then I would need to go to Mozambique or Ethiopia or something like that. because for me, there's not really a geo arbitrage opportunity. If there's anything that I sometimes daydream about, is like moving to Portugal or something like that, relatively tax friendly. But I will not never do that with my kids at these ages. If they are living on their own, maybe then I could say, like, you know what, buy a summer holiday house in Portugal at the seaside, spend there more than 200 days a year so that you need to pay your taxes there. But for instance, spend the summer in Poland and be with the kids and family, something like that.
Yeah, I could tell you for a fact my wife would not move. She's a homebird and would never live out of Ireland. And honestly, the older I'm getting, the more I think I wouldn't bother either. I mean, all my friends, all my family, everything I know is here. So
It's
what?
much more important. Much more
Yeah,
important.
yes. What am I going to do? Get up and leave everyone, leave everything, drag my wife halfway across the world to a low cost of living and have nobody there? Makes no
Nah.
sense. Makes no
And
sense.
then you die of a heart attack a week later.
Yeah, exactly. Philip has asked us, you've recently talked about trimming positions from your portfolio by selecting best companies in a given sector. I want to ask you the opposite. If you're happy with your positions, how do you choose a company in which you enlarge your position in a given week or month?
Well, I do this sometimes. I work with this tier 1 to 4 system, and sometimes I understand the company better. Let's say HPQ, HP Inc. It was a tier 4 company. I moved it to tier 3 and maybe even to tier 2 at a certain moment. So it allows me to buy a bit more again. I have already quite a decent position. So I'm not buying now, but if there's an opportunity that it goes to, I don't know, $26 or something like that, I might be pounding the table. So this tier system allows me to sometimes upgrade a company, and which means effectively I can buy more of it. Allow myself to buy more. But for instance, with Unilever, I will probably decline it. And by declining or lowering Unilever, I would need to put another company in place where I create space for myself again. Those are usually the ones that are, in my opinion, at that moment having momentum and being a high quality company.
Yeah.
So I'm doing this actively, both on the positive and on the negative side.
Yeah. It
It
is.
doesn't happen too often because I don't want to have it happen too often, right? Maybe once, twice a year. That's it.
Yeah, of course, because I mean, you have your theses, and if you have to
Yeah,
constantly drop them out, that means something in your selection process
exactly.
is wrong, inherently. So it is tough. I mean, you look at it, you could look at it from a valuation point of view, but then you have companies we spoke about. We spoke about British American Tobacco, for example, who was heavily undervalued. But do you really want to keep buying that type of quality of company, who's, I would not say the highest quality, I would put in medium
Mhm.
quality, just because they're undervalued.
Yeah.
So I I do look at value a little bit more, but I don't want to be overweight in a particular company, particularly as my portfolio is relatively small, I would say,
Yeah.
because that increases my risk. So I try and balance it out over my portfolio
Yeah.
over the year, based on, because there's always one or two of the companies
Yeah.
that I believe the valuation is attractive. So that's what I try and do.
Yeah. Yeah. Nice.
Richard has asked us, creation of an EDGI dividend portfolio for fun, perhaps based on polling your followers. He'd happily throw some sharpening towards this. So, what would your five must-haves in this theoretical portfolio be? 10-year timeline.
So really, really quickly, I haven't thought it through and a little bit diversified. So consumer staple, I would take Ahold Delhaize. Um, Industrial, I would take Siemens.
Yes, I
I
agree.
would take Defama as a real estate investment trust. I would take LVMH. No, no, no. I would take at current prices probably L'Oreal as more like kind of a luxury company. Yeah. So there's four, and then what sector am I missing? Maybe
Uh, Industrials, technology,
yeah,
materials.
industrials I had already.
Oh, you
So
had
I would go then
Siemens.
for energy. I would take Shell.
Yeah, yeah.
Yeah,
I would probably pick Agree Realty over the
but
Pharma.
that's not European.
Is it just European?
Yeah, European dividend growth investing
Ah,
portfolio.
very good. So I won't pick Agree Realty. If I was stick European, I would stick with TR Property Trust. That's a CEF, purely because they invest in a whole range of European
Hmm.
REITs. And I find European REITs quite difficult compared to the US ones. Agree with Ahold, agree with Siemens. What should you pick? L'Oreal?
Choose your own.
No, I would pick Siemens. Would definitely
Yeah.
definitely my one. But there is a company that's quite interesting out there. It's a semiconductor one, which is called Melexis, which I'm looking at
Hmm.
the moment. It's a play on automation, but also in electric vehicles without investing in electric vehicles, or
Yeah.
the automation, or the automotive industry. So I think that's quite a good one as well. And then I'm going to stick with some more investment trusts as well. So I'm really heavy on green coach UK wind. I think renewable energy is here for the long
Yeah.
run. So
So why not Iberdrola?
Iberdrola is hydrogen. I
10
mean,
euros 60.
10 euros 60. It's coming into a good price. But also UK wind have a specific dividend policy that hikes it in line with inflation. So you're always in line with inflation. So if inflation is 20%, you're getting a 20% dividend hike. I don't think Iberdrola has the same type of dividend policy.
Okay. Yeah. Yeah. Good.
Um,
We,
Pavel,
we we will do it as a poll. Yeah, I will put this as a poll
yeah,
in the podcast and see what others
yeah.
choose.
I actually wish I read this question before before we got to this, because I would have thought it out. But I think it's a good poll to ask. Pavel had asked us about claiming refunds of dividend tax. Have you had any successes?
I've had success with the Swiss from Switzerland, not with Germany. If Germany didn't accept my papers, but I hear mixed stories there. Sometimes they do, sometimes they don't from the hero. Yeah.
Um, Klassen has asked us, what are your guilty pleasure spendings?
My guilty pleasure spendings that I mean for me in the summer it's ice cream. Like
Ice
like
cream.
like not from the supermarket, right?
Yeah,
The
proper.
scoops.
Yeah,
Yeah.
yeah, yeah. Mine is coffee. I honestly, I buy some load of coffee. I'm not going to get rich according to according to FI on Twitter, but I just, because do you know what it is? You know this, over the weekends I'm away pretty much
Yeah.
all the time. The kids are playing matches. They're
Yeah.
traveling all over the place. So it's good actually to sit down with my wife. I work during the
Yeah.
week. It's probably the only time we get to sit down and have a chat. So we
Yeah.
try and do that. If it's 15 minutes, have a coffee and we sit down and chat. It's
Nice.
nice. I actually miss owning a coffee shop because I never used to have to pay for it, and now I do. So it's kind of sucks. Johnny English has asked us, what is your take on the broker app Trade Republic?
I can't use it. It's not available for me.
Oh,
I believe it's mainly in Germany, right?
I don't know. You can definitely use it in the Republic of Ireland because I've seen it pop up on
Okay.
our boards quite a bit and in some of the FI groups that I'm in. So it's definitely possible to use it from here, but I have never used it, so I don't know. I'm quite
Yeah.
happy with the two I'm in. I don't need a third one yet.
Yeah.
So maybe as my portfolio grows, I'll expand, but at the moment, I
Yeah.
don't know. Sorry, John. Lord Willie Coyote. That's a great name. What shares or sectors are showing warning signs looking to sell?
Well, of course, all those with litigation, but if you look at the shares, but if I think about an industry that I would avoid at all costs, is office real estate at the moment. I just don't see still, although more and more companies are strengthening their in-office policy again, I just don't see it ever returning to where it was. I just don't see it. And they're heavily loaded with debt, and just one little thing needs to go wrong, and this can all collapse. That's how I think about it. So office real estate, I would stay away from as far as I can.
Yeah, it's a tough industry, and of course we had Brad Thomas on who spoke about
Yeah,
how difficult that was as well in that industry. But the ones that are left, there are some strong ones there if you can pick. But you I think you need to know that industry. You need to know the
yeah,
areas of where these offices are fairly well because it's going to be different based
yeah.
on geographic um geographic reasons. So yeah, I think that's a good one to choose. David has asked us, I think 2 episodes earlier you mentioned in the discussion that they are great Swiss stocks. Perhaps you could explain this topic a little bit more. I know we've done some episodes on top Swedish stocks and stuff like that. So I think Swiss would actually be a good one to do. There are some good companies. I
Yeah.
I spoke about Roche on this show quite a bit. We've got ABB. We've got a couple of others. I look. I find I struggle because I don't invest in Swiss stocks directly because of the high dividend
Yeah.
tax. So I don't give it too much attention. But I think it could definitely warrant a show because yeah, I think it does have some high quality companies there.
Yeah.
And Rafi has asked us, have you ever considered as a value play or just for fun to invest in a sports club, like Borussia Dortmund, for example, or even the UFC or WWE or those type of companies, like a sports company?
No, no, because sports is emotions, and actually, I don't like it that those clubs are owned and traded on the stock exchange, like Manchester United and Ajax is similar. It's emotions. It's not for me investable. But as he mentioned, just for fun, no, because for fun, I buy an ice cream.
Because you're a serious investor. That's why.
Yeah, well, I get what he means, but I no, the answer is simply no. I never considered it really.
Yeah, I mean, the only club that I would is Liverpool because I support them and I feel if I'm going to invest, even if it's just for fun, I want to be helping the club I support. I would never in a million years invest in someone like Manchester United. That would break my heart. Um, but if I was a supporter, I could see, but as you said, there's too much emotion involved in that, and just because your club is doing well doesn't mean the share price is doing well. But speaking of which, did you see what happened to Ferrari share price when Lewis Hamilton got
No, it went up.
oh, it went up? Yeah, it went up 7 or 8%. It like jumped, it went phew, just because of
Well,
Lewis Hamilton. So he has big boots to fill there, I think.
I believe Ferrari the last 2 seasons they are champion in making the wrong strategic decisions. So
Yeah, and this might be another one. Keep Walking has asked us, what is your opinion in relation to realty income expanding into the European market?
yeah, and they bought more Decathlon stores. Do you have them also in Ireland, Decathlon?
Decathlon, yeah, we have.
Yeah,
We have
honestly I love it because If you just want to have some quick stuff for a holiday, camping gear, you can get it there. I don't go there for the very high quality stuff, but with the kids that grow so quickly, a pair of I don't know, a sweater for sporting, it's really good. Realty income is now at this size that it had to go into other territories, I guess. It's such a big whale now. I just don't find the real estate market in Europe easy. So I feel that realty income's risk profile just increased already. And we saw it also with what they are buying the properties in Vegas.
Yeah.
Vegas. So for me, just it's not anymore the one that has the Walmart stores and the Dollar General only. It needs to now make these moves, and I think it's increasing the risk in the portfolio. That's what I think about this. I still think that the risk reward is well good enough. I also think that they have really good management. I just hope that they know what they are doing in Europe.
I mean, I'm sure they have good advisors or boots on the ground in Europe, because it's a different landscape than America in terms of real estate. So it's tough. But I mean, buying 30 Decathlon stores in Spain
Yeah,
doesn't seem too risky to me, to
no,
be
and
fair.
those are really cheap buildings typically.
Yeah,
Some pieces of metal stuck together.
yeah. So
So
if they stick to those types of stores, I mean, I'd have no risk. You could probably see him taking over some Aldi's or Lidl's and stuff like that as
yeah,
well. So
or
um,
buy the Fama.
or buy the family. Yeah, they could do
Yeah,
that. So it's as you said, it does increase the risk, but I've no issue with the types of properties that they're targeting at the moment.
true, true.
Dividend Yogi has asked us about Cisco Systems. He's just opened a position and he would love to hear our opinion on them.
I looked very often into them because they always had a really nice yield in combination with dividend growth when I looked in, and I'm talking about 6, 7 years ago. My issue is that I can't because I always force myself to write down in my paper notes what is the thesis of buying them. I just can't. I just can't. I think now, okay, the desktop phone that I used to have, we don't use it anymore. How many more switches do we need in the world? So for me, it is really hard, and I'm not. Yeah, no, it's easier for me to look at Ahold and see the lines and see that they're innovating with self checkout and everything. But with Cisco, I just don't. I feel like they missed out on a lot just over the years, right? And still, I think for what they are doing, they're doing it relatively high quality, but they missed out on a lot of technological trends over the last decades, and that's why I'm not investing in it. Just it may be a good investment, but you need to have a feeling for it, right, with what you own.
Yeah, yeah. I don't know is AI to play here, or what's driving it, but what I do know is there's a slight crossover in automation and the IT world. And Cisco is known for its quality. I mean,
Yeah,
we use all their switches when we're buying
yeah,
new switches for our racks and stuff. So I think it's quality products, but I haven't stayed too close to the company. I remember looking at them 5 or 6 years ago, and I was concerned about where the growth was coming from.
yeah,
And I haven't looked back into them since. But looking at the share price, it looked flat for that 5 or 6 years. So
yeah.
I assume my thesis was right at that time. But I don't know what the play is here now. Is AI driving it now? Or are they going more into the cloud? I don't know. But as you said, it's a solid blue
But
chip.
can you put a switch in the cloud?
No, no, you can't put a switch in the cloud. But they do more than just switches.
Okay.
Um,
Bec-
but
yeah, you need a switch in a data center probably.
yeah, exactly. Um, But yeah, as you said, solid company, blue chip company. It's never going to go out of business anytime soon. But I haven't stayed too close to give an honest
Yeah,
opinion about what I think, other than it's a great brand and I love working with
yeah,
their products. Yeah.
yeah,
Gordon has asked us about Unilever and Danone. We've spoke about Unilever already.
yeah.
What's your thoughts on Danone? They seem to be positioned a little bit better than Unilever.
I think that the strategy of the CEO that I think got into the game 2 years ago is starting to slowly play out here. So the stock also starts to recover a little bit. I'm very curious to their earnings. Let's say like that. But honestly, at this moment in time, I would not deploy any money in both of them.
Um, Abraham has asked us about Swedberg's group. Have you got a chance to look into them?
No, no,
No.
no. Sorry, we need to put that one on the back burner.
Yeah,
He
yeah,
also asked if we can make a dividend talk group on X or Twitter. I mean, Abraham, why don't you make it and just invite us? I will come there. For me, the issue is that I'm managing already so many social media areas that's just a bit too much. But if you open up something, Abraham, and you call dividend talk, just send me an invite, and we can share it on X, and then maybe others will also join.
yeah. The next question is from Dee's about AGCO. I don't know if you got a chance to look at them. They are a competitor to John Deere. They're in that kind of agriculture market.
Okay. Yeah.
So I looked at them briefly. I was looking at John Deere recently, but I didn't dig into the financials like that. It's a similar stock, I would say, to John Deere. It's in the same markets. I think there's lots of tailwinds in that industry. So it could be a good company to look into. I don't know about valuations. I don't know about their financials, but I do know that specific industry. I think there's big tailwinds, especially with a growing population. They all need to eat. Farmers are dying out. It's a dying breed. Nobody wants to work long hours, so automation is going to be key here. And if they are like John Deere, which I assume they are because they hold a similar market share, they could be good to invest in depending on their valuation. So I
Yeah.
think it's definitely one to look at. There's also a European version, CHI Industries as well, which I would probably look at as well. So I don't think you could go wrong with either of the three of them. It's just a valuation thing, in my opinion.
Yeah.
Ivan Mitchell has asked us about Johnson and Johnson. What do you do long term? Lawsuits is killing financial growth. Is the dividend still safe?
So, yeah, for me, Johnson Johnson is a long-term hold. Yes, the lawsuits are having an impact, but I don't see the lawsuits being an issue like it is for 3M or Philips or Bayer in this case. I'm feeling actually quite okay with it. But it's now a pure play biotech company, pharma company, biotech. So that's where the risk is. And
Yeah.
is the dividend safe? Yes, the dividend is safe according to all metrics right now. Is it the strongest dividend dividend safe profile I know? Definitely not. It's not anymore our grandfather's Johnson Johnson, let's say, but it still fits well in my portfolio. So I cannot recommend to you Ivan what's good for you, but in my portfolio there's a steady Eddie place there.
It's so funny, right? It's so funny to hear. Is it the strongest in terms of dividend safety? This company's got a AAA balance sheet, and we're saying no. It's crazy.
Yeah, yeah. No, because for instance, for me, Microsoft has a stronger one, or yeah, some of the others like Apple and such.
Yeah,
Of course, different companies, different profiles. But I'm mostly saying it from a point of view that it became now very much depending on its pipeline, and yeah, it is triple A now. So of course, it's like you say, it is for me. It's a very steady Eddie position in my portfolio.
yeah. I think the risk profile has increased dramatically, but this I'd have no concern with dividend safety at the moment.
I mean, they can leverage still, so they can still pay us 10 years of dividends hikes just by leveraging up the balance sheet without getting in trouble.
Yeah. RMS has asked us about Enel, Enel SPA. It's an Italian utility. I think we were asked this question before. We briefly
Yeah,
looked at them, and they actually did look good, if I remember. And we've put them on the back burner of companies to
to look
analyze
into. Yeah,
analyze further. But that list gets bigger and bigger, honestly,
yeah.
every time we speak. But if I remember correctly, they had some good growth, good dividend growth as well. So I mean, I'm not
Yeah.
opposed to it. It's on the list. It's on our spreadsheet somewhere, and
Yeah.
we'll get to it at some point, I would say.
Yeah.
Manny Mystery has asked us, have you ever looked at the automotive industry recently for a dividend growth investing stock to add to your portfolio? He's recommended Stellantis. It looks very strong, has a low PE. BMW also has a low PE, and the yield on cost makes this a compelling addition. What are your thoughts?
Yeah. I owned General Motors a little bit in the past, and that's when I started to experience what Warren Buffett said about the car companies are uninvestable, and I came to the same conclusion, and I'm staying away from it.
Yeah, I mean, we talk about cyclical industries, and I mean they are
Yeah.
boom bust. They are boom bust.
Yeah.
As I said, I gave a company Melexis. It's a Belgian semiconductor company.
Hmm.
They are heavy in electric vehicles. I think the majority of their revenue comes from that. But in my opinion, that's a better play because everybody needs integrated chips,
Hmm.
and they're not just in automotive; they're in other areas, even though that's the biggest. So
Yeah.
there's room for them to step sideways if they need to. So I personally don't like going directly in the automotive industry, but there's definitely plays around that are interesting, particularly as this shift to EV looks like it's going to go full steam ahead. So there's definitely some other areas there that you can look at. Um, Lucian has asked us, what do you think about T. Rowe Price compared to BlackRock?
T. Rowe Price.
Yeah, I mean, it's tough, right? BlackRock owns the world. Let's be honest. They own
Yeah.
the world. They're huge. They have their own ETFs. You can see where the growth is. T. Rowe Price has a better balance sheet, but they struggle in that ETF department.
Yeah.
I know they're releasing that. So I don't know why you have to compare them. Own a little bit of both, and you're probably in safe hands.
Yeah. Sure.
Um,
Good. This means we're at the end of the podcast for today. It's quite a long one, I think. I haven't checked the time, but for everyone who's still staying with us, thank you so much. It's been an awesome week with all these earnings. So I can only hope for more of this. I mean, we still have some awesome companies to come, right?
yeah,
You mentioned Coca-Cola, but Ahold, many European high quality companies will still be reporting their earnings. So
yeah.
looking forward for next week again.
As always, and thanks to all our listeners for sticking with us this long. And we will talk to you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.